Many traders possess sufficient market information. The primary challenge lies in consistently applying this knowledge. Market pressure often hinders the effective use of information. Inconsistent application leads to trading failures. The market penalizes certain behavioral patterns more than a lack of information. Hesitation in decision-making can lead to missed opportunities and financial losses. Arrogance often results in overconfidence and poor risk assessment. Emotionally driven decisions frequently lead to impulsive and irrational actions. Knowledge alone is not enough. Disciplined action is crucial for market success. Many novice traders begin with limited capital. Initial successes can create a false sense of market mastery. This premature confidence often leads to overestimation of trading skills. Traders may incorrectly attribute early wins to their own abilities rather than luck. This overconfidence can result in increased risk-taking and potential losses. Initial success can often be attributed to chance rather than actual skill. Randomness in early stages may lead to profits, creating a deceptive sense of competence. This early success can foster a false sense of confidence. The illusion of skill can arise before true discipline and expertise are developed. Genuine skill requires consistent application and learning, not just initial gains. It is important to distinguish between luck and skill to avoid overconfidence and poor decision-making. Overconfidence in trading, without a structured approach, escalates risk exposure. Traders may prematurely increase their position sizes due to overconfidence. This premature increase amplifies potential losses if the market moves unfavorably. A structured approach mitigates this risk by providing a framework for decision-making. The market's behavior is dictated by current price movements. Past market performance does not influence present market reactions. The market operates without memory of prior events or trends. Historical successes are not indicators of future market outcomes. Each moment in the market is evaluated independently. Therefore, strategies must adapt to real-time market dynamics. In trading, the primary goal is to ensure survival in the market. Survival takes precedence over being correct in every prediction. The market structure is designed to evaluate a trader's discipline. It is not structured to confirm or validate individual opinions. Discipline is critical for navigating market volatility and uncertainty. Focusing on survival helps maintain a long-term perspective in trading. Successful traders prioritize capital preservation over high-risk strategies. Emotional control is more critical than raw intelligence in trading. Understanding market dynamics is essential for making informed trading decisions. Discipline and patience are key to consistent profitability in trading. An unmanaged loss can significantly undermine prior achievements. The impact of a single loss can negate months of consistent gains. In some cases, a loss may even erase years of accumulated progress. This highlights the critical importance of effective risk management strategies. Diligent risk management is essential to protect against potential setbacks. Proactive measures can mitigate the negative consequences of unforeseen losses. Failure to exit a losing trade can be a detrimental error in trading. Minor losses, if unaddressed, have the potential to rapidly intensify. Promptly addressing losses is crucial for effective risk management. Ignoring small losses can lead to significant financial setbacks. Disciplined exit strategies are essential to prevent escalating losses in trading activities. Emotional trading occurs when feelings dictate investment decisions, overriding rational analysis. Hesitation and attempts to justify decisions often replace decisive action in emotional trading. This shift causes traders to lose control, allowing market fluctuations to dictate their moves. Hope should not be a primary driver. Logic and strategy must guide trading activities. Successful trading requires discipline and the ability to detach emotions from financial decisions. Professional traders acknowledge that losses are inevitable in trading. Their strategy focuses on swiftly minimizing the impact of these losses. Accepting small losses is viewed as a necessary cost of conducting business. The key is to manage losses effectively rather than attempting to avoid them entirely. In trading, the inability to accept small losses can lead to significant financial consequences. The market will eventually impose larger losses if minor ones are consistently avoided. This highlights the critical role of proactive risk management in trading strategies. Effective risk management involves acknowledging and addressing potential losses early on. Traders should set stop-loss orders to limit potential losses on any given trade. Ignoring small losses can result in a forced, much larger loss by the market. Many traders make decisions based on emotions rather than a defined system. These traders often enter positions based on feelings. They also exit positions based on feelings. This contrasts with systematic trading. Systematic trading relies on predefined rules and strategies. It aims to remove emotional bias from trading decisions. A trading system is designed to react systematically to prevailing market conditions. The system dictates specific entry points for initiating trades. It also defines the amount of capital to allocate and risk per trade. Exit strategies, including profit targets and stop-loss levels, are predetermined. Finally, the system provides rules for when to abstain from trading altogether. A systematic approach is crucial for effective performance measurement. Consistent improvement is unachievable without a structured system. Rules are necessary to provide a foundation for objective performance evaluation. Objective evaluation ensures fair and accurate assessment of performance. Emotions exert a subtle yet significant influence on trading decisions. Fear can lead to holding on to losing trades longer than is strategically sound. Greed may cause traders to exit profitable positions prematurely. Greed can also encourage traders to take on oversized positions, increasing risk. Discipline in trading requires overriding instincts, especially when those instincts are incorrect. This is particularly important when operating under pressure. A key component of trading discipline is the ability to contain emotions. Emotional control prevents impulsive decisions driven by fear or greed. Acting rationally rather than emotionally is crucial for consistent profitability. Poor position sizing is a primary reason why traders fail. Entering positions that are too large amplifies risk exposure. Oversized positions increase the likelihood of panicking during normal market fluctuations. Inability to withstand market volatility often leads to premature trade exits. Proper risk management involves appropriate position sizing to mitigate potential losses. Professional traders often use exposure scaling as a risk management technique. This involves gradually increasing the amount of capital committed to a trade. The initial position is typically small, representing a minimal risk. Traders wait for the market to move in their anticipated direction, confirming their analysis. As the market validates the trader's view, they add to their position. This approach allows for a more controlled and confident deployment of capital. Risk management is fundamentally about controlling the potential magnitude of errors. It is not about achieving infallibility or predicting outcomes with absolute certainty. The primary goal is to limit the extent to which decisions can be incorrect or detrimental. Precision in risk assessment and mitigation is critical for long-term success and survival. Effective risk management involves strategies to minimize negative impacts. Understanding and managing potential errors is more important than striving for perfect predictions. A fundamental rule in trading is to minimize losses and maximize profits. This involves cutting losses short to prevent significant financial damage. It also requires allowing profitable trades to continue running. However, many traders struggle to consistently adhere to this rule. Emotional biases often interfere with rational decision-making. These biases can lead to premature profit-taking or delayed loss-cutting. Fear often drives investors to prematurely sell winning investments. Hope can lead to holding on to losing investments for extended periods. Successful traders often exhibit the opposite behavior. They tend to hold on to winners longer to maximize potential gains. They also cut losses quickly to minimize financial damage. The market's behavior often mirrors a trader's own habits and tendencies. A trader's actions and reactions influence their perception of the market. By identifying and correcting negative trading behaviors, traders can improve their market interactions. Addressing these habits transforms the market from a perceived threat into a manageable challenge. This shift allows for a more controlled and strategic approach to trading. Ultimately, self-improvement leads to a more positive and effective trading experience. Failure in trading is frequently avoidable with the right approach. Addressing and correcting behavioral issues is crucial for traders. Discipline is essential for achieving long-term success in trading. Consistent profitability is a direct result of disciplined trading practices. Therefore, mastering discipline is key to minimizing failures and maximizing profits.